What you're observing in this animation here is how the correlation structures jump during market distress. They change over time. I'll play this animation for us again here. Boom. Right when we end up in distress, we can see the correlation structures fundamentally change. Everything becomes increasingly correlated with each other until the volatility comes back down. It's a mean reverting process after all, and the correlation structures go back to their typical range. Typically, they are mean reverting in themselves around a particular level, similar to what we're seeing here after the distress. It should now be more clear from a quantitative perspective why we can't diversify away market risk. I'm not talking about buying a put. I'm not talking about hedging. I'm talking about diversification in its purest form. The only free lunch in economics. That's exactly what we're seeing here. We're seeing the statistical mechanism used for diversification break down. We can see during distress, everything becomes increasingly correlated. We don't get that benefit, and we suffer from that market drawdown. Now, once everything normalizes, we will then be back to business as usual, our typical uncorrelated sectors and firms. But during market distress, we can see everything becomes increasingly correlated. So if we diversify away idiosyncratic and industry risk, what are we left with? Well, we're just left with market risk. In fact, I'm only holding an equally weighted portfolio of 9 stocks across 3 different sectors, but look at how closely we track the S&P 500. It is just an echo of that price path, and the rolling correlation, that is the correlation between this composite portfolio of 9 stocks and the SPY ETF, is incredibly close to 1 even over time. That's because we've diversified away effectively all of the upside and downside potential from each individual firm and each individual industry. It's important to note here that if we hold a portfolio of just one equity, we're going to be subject to all of the gains on the upside, but also all of the losses on the downside. Whether or not this is a good idea isn't what I'm discussing. I'm not talking about it in a cross-sectional priced risk way. I'm talking about it just explicitly as holding one stock. If you hold one stock and you're not diversified, yeah, you are going to ride all of the upside and all of the downside. Now, whether or not this is a good idea, we can look in the cross section at the idiosyncratic exposure. Typically, that is negative, meaning a lot of retailers are going out and they're just looking for this lottery ticket effect. They'll load up on a particular name and try to hit it big. But on average, it suggests that holding a single equity is not a good idea. Again, that doesn't say anything for your particular situation. You could get lucky. Maybe your fundamentals are really rock solid and you're going to ride a tremendous upside. But in terms of pricing and priced risk components, the theory says that may not be a tremendous idea. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long-run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.